Well, good afternoon, everyone. Scott Henderson, shooter. Just going to go through a couple things on the weekly recap and our market outlook. Now, this is for June 12th, 2026. And let me start off with the SPY here. All right, so I want to compare what I see between the S&P 500 and the NASDAQ. Note that on the S&P, we're not confirming. Our confirmed high, I believe that was in July of 2025, where we had our prior confirming high. So this entire structure is mound one, as far as I'm concerned, in this leg. So we should get an equal wave three to that distance or larger. So I'm being very conservative when I'm coming up and putting this sell box up here around the 1618. I do believe that it extends. Now let me jump over to the dollar. Now right now, this little wick off that we got here, this little red candle, is the reason equities ran. So anytime the dollar flushes to the downside, equities should rally. Anytime the dollar pushes to the upside, equities should come off a little bit, retrace. And this has been textbook that we can follow. I mean, there's some variations, but if you actually peg it using an hourly chart, you can be pretty accurate just using the dollar as a tell versus where we used to be able to use the VIX, we can't now, and the dollar is actually much more decisive in that. That said, my skew is the dollar is bearish equity. So we're getting a counterintuitive move. So we have some relative strength that happened this week in the equity. Now let me jump to TLT. Now my view has changed with this noise right here. Realize it's almost the exact same noise as here. Not quite the same noise. Notice the difference. You just said it for euphoria. This is where everybody thought the Fed shifted. Right now we have FOMC this week. So that's one reason you got this video, because I want to explain that a little. We want to watch for a general candle to that upside that generates. And literally, if we think the Fed is shifting, this is what we should see. Now, my bias is accumulate here simply because of that look. Even though we have this pullback here, notice that we took out that 91 from where we are at 85. So it's probably a good place to camp right now. All right, now let's talk about SMH. I think we extend. I think I'm extremely conservative here. I have numbers up at 1150 from where we are. At 619. I think the numbers move up. By the way, these little boxes are now my edits for AI. I'm now teaching AI aggressively, trying to fine tune my mound theory and everything inside a large language model. So I'm animating my charts to reflect that so we can go and back test everything and really try and predict the better side of the market based on my theory. All right. So I think SMH, now note I took my bias box off. This is my golden box retrace. So I don't think we're going here now. I think we're extending. I think it's peaking drive 1, peaking drive 2, and wave 1. So I'm thinking we get a peaking drive 3 up around 692. Then maybe we get a little pullback. But I would not be surprised if we do not take out the shelf back around 575. I think it's going to be very euphoric. This is near a parabolic move at this point, which actually punches us right up to that 1150. All right, just briefly, sector rotation. We had some decent moves. I'm looking at this from a 5-day standpoint. We had certain names that ran, other names that were soft, other names that pulled back. Notice the rotation. I actually think Apple, Microsoft, and Amazon are potential buys. I even like Oracle, PLTR, a couple of other names. The sentiment and the flow is shifting for me. I'm now skewing bullish, but obviously being in a Fed week, I'm light. So we go out to the monthly. We had a good month. We go out to the month to date, and I wanted to show the difference is that how dynamic or divergent those looks are versus where we are in the month versus what the entire month looked at, including the last 2 weeks of the prior month. Now, year to date, everything's still bullish with the exception of Microsoft. Now, I'm pointing out Microsoft is because we're struggling with this capped X note that we have. In other words, where we expect entities to be able to monetize cleanly. Google, AVGO, when we look at that, Nvidia, Apple's a little light. So basically, we have this box, consumer electronics and software infrastructure, that's lagging what I would consider to be the dominant AI, which is Google right now being able to monetize. However, what Google just purchased, I'm hesitant to chase it here for that reason. But I'd also like to point out the outlier here. GEV, these are industrial, aerospace kind of move. I think GEV gets really going. I think some kind of deal has to happen in the natural gas generating engines for power source. That is our only immediate source of power to power the AI infrastructure that's not, because everything else is 3 to 5 years out. Once you install the gas turbine and pump the pipe in there, we're talking weeks for them to put a new generator, them giant cat engines like they have dump trucks they use in the mines, because it's that big. They're very, even though Mitsubishi produces significantly, GE dominates the US market, even though Mitsubishi is growing, and obviously they actually might be able to generate capacity quicker. But I wanted to point that out. Now, when we come out and we look at the 3-year map, this is where I know he's just silent. So here's the price of not being invested in the right place. And just look at the gains on Nvidia, the gains on AVGO versus the gains in Google. And look at Micron. Do we get any kind of pullbacks in Micron? I mean, it's just bottom line, the ratio over the next 3 years. And realize we have not seen the full dominance of chips yet. If we have 100 gigawatts on the ground now, and by 2030, if we're going to be at 300 gigawatts, okay, I'm not including SpaceX. However, SpaceX shouldn't exceed 25 gigawatts, maybe 30 gigawatts max. But I think we're probably realistically looking at 10 to 15 gigawatts in 3 years. If we hit that, it'll be substantial, but it'll still be less than 10% of the total compute out there. So just think of, we're still going 2x from where we are now as far as these numbers. So the risk to the downside is that you're not invested in the right place. Now, I am reorganizing aggressively off of where we are after SpaceX. The reason is these pullbacks, I'm getting real interested, especially some of the semi names that have pulled back, that have held up, some of the infrastructure plays, and we'll be updating that at a later point in obviously our group. All right, looking at the 5-day rotation, nothing really crazy here except for, notice how energy came off. There was a preemptive understanding of the fact the war was ending, and I don't know that Mr. Market saw it as quickly as energy came off. So sometimes looking at sector rotation, it gives us a significant tell. Now notice how information tech just led. So SaaS actually started to recover. So we want to look at that adoption and realize the price factor of what's going on with everybody capping the limits of their teams to use AI because of the expense. I think that is going to be a significant driver for existing SaaS, because what you're going to have are, like for example, Monday, for example, if they're capable of running AI models internally. In other words, their team is running all the data that everybody wants inside Monday, inside their group, inside their organization. And then they can repurpose that knowledge into Monday as a SaaS provider. They now will dominate individual teams trying to regenerate that, because you have the learning curve that every company is going to pay for. So I think that type of monetization inside existing SaaS is going to be a huge future growth area, because those entities that are successful in doing that is just obviously going to continue to dominate. But back to rotation. All right, 1 month, note the difference between energy and infotech. I mean, it's just, there's just, you're either in the right place or you're, like for example, if you've invested in some core healthcare, you're down for the year. All right. And however, on the other hand, if you invested in consumer discretions there, you're up 4 points. You would have been better off in your savings or your mutual fund or money markets, excuse me. Whereas energy led for the year, infotech was behind it. Now, this was all a war pop, so that'll level out. Infotech will again lead again. Now, year to date, I like to focus out on the 3-year picture versus the year to date, because it really gives us a key visual of how well we do. So, and usually if we look at the history of growth, you're going to have financials, industrials, communication, and infotech. So first question is, how should you be organizing your portfolios? Should you be overweight healthcare because it's been a lagger, right? Or should you pick your leaders and divide accordingly? Well, my premise and what I've studied with AI at this point and putting everything into the models, the model is that we should have a higher percent in infotech, a little lesser percent, maybe 5% less in communication, about 5% less in industrials, and about 5% less in finance. However, we also want to watch the seasonal rotation because we may want to roll into financials around year end because they tend to do very well going into the January season. Okay, let's take a look at the NASDAQ. Now, one thing I'd like to point in the NASDAQ, we are confirming. Notice it is our highest high in RSI and our highest high in price. Okay, thesis, really simple. Mound theory, basic 101. When we get a confirming high in the center of a mound, the mound structure for me is trough, peak, trough. All right. So when we get a confirming high, like right here, the second drive. So this is drive one, this is drive two, this is drive three, even though you got a group, kind of an ABC structure in total. Still viable, still within theory. So we have this confirming high in what I classify as peaking drive three in wave one of the larger mound structure. Peak trough is here, peak will be up here, and then it'll roll back over and give us a similar amount. Should be longer than the entire wave three here in this structure. And the reason is because I'm looking at this as a full corrective leg, and we're building out an aggressive impulse, probably parabolic back to the upside. So the upside here, and we really need monetization to kick in. So I'm going to go back to the names that I mentioned earlier. Apple, Microsoft, and Amazon are playing catch up. If they're, Jeff Bezos announcing that he was going very aggressive in raising capital for AI infrastructure is really simply to tell. Basically, what he's telling you is he's behind. He's going to try and develop what I just described in SOT as a delivery mechanism through AWS. So everybody else doesn't have to pay their individual teams to learn AI and have that learning curve disadvantage as far as the capital expenditure. Again, if he's successful doing that, to be honest with you, I have a little confidence that he might do that. Next point, MACD is wide open. We have a huge wick off. This is much more bullish than the S&P 500. All right, just moving along. Bitcoin, we could be done right here. Technically, it's met the condition for an ending diagonal where wave four is longer than wave two. All right, all we need is a price overshoot. One shot below, we got it. We got a second wick off. My bias is still this spot. And the main reason is because you got all this noise up here, wick off. You have conviction here and you have conviction here. We're below this. Okay. We've just tested that. I think it tests this shot. That's my thought. I think it does because it's the most common structural place. We went down and wicked off it from the bottom, wicked up. Okay. It was here, failed here. So there's really not a lot of negative gamma coming in right here at this level. I would not be surprised, and I'm not looking at negative gamma here, but I would think it'd be sitting down there between 15 and 20,000, and positive gamma comes in back up here probably about 80,000. So maybe a toe in the water in Bitcoin. Toe. I like IBIT. I still like XRP. I still like Link, and I like Cypher mining was converted to an AI infrastructure. I like Hive, and that's sort of the only place that I'm camping a little bit with as far as that's concerned, because I do think a chunk, I don't know whether it's half of the existing miners are reallocated towards AI infrastructure. Simply being is because they have the power, they have the servers built. All you need to do is go and switch out the server boards or the board, and now you have a AI data center. And to be candid with you, there will be some units that can run both, depending on how their power supplies were ran and whether or not they had any intellectual insight on AI's development at that point when they built out the mining hardware, the server racks and everything else there. Now, I've been very similar view. Main thing with here is I see equality back down here around 32, 31 and a half, right in that range. You got a decent wick off, but not quite as solid as Bitcoin. And I'll note that IBIT is probably a better tell than the Bitcoin chart, just to note that. All right, looking at crypto, Bitcoin dominance is above 56. Typically, Bitcoin leads. The flow, as far as where everything was going this week, beat came in. I'll leave you to review that in the actual article. Everything pretty much was green except for WLFI and ZEC. Okay, as far as the heat map's concerned. Now, what I've started to add are these cross-market comparisons because I think, one, we have, like, for example, currencies. We have bonds, we have stocks, now we have crypto, right? We're also going to have stable coins that become dominant. So I think these categories develop where we spread out. So some of the funds who would normally be going into Bitcoin will go into Ethereum or stablecoin because the liquidity is still going to be similar to what it was. unless the market is fully expanding and somebody can trim off a piece from Bitcoin and buy some Ethereum, buy some stable coins, as long as we're relatively flat, and realize a large chunk of the holders are underwater still at this point. But I want to give a cross-market read just so everybody can get the bigger picture look. That's really what the intent of that is. All right, now something else that I'm really focusing on here with flow and insider activities, I'm really focusing on the 10% owners and trying to follow. Matter of fact, I've got some AI tools that are tracking this to alert me on trades over a certain size, because I found that chasing the whales are very important to where the money, because most of the time it heads in the right direction. Like, for example, I'll use the SMH trade that we did in our group. We took significant heat on that at the front door, completely took it out. We closed the position on Friday going into the SpaceX IPO. Reason is because I wasn't sure if we'd have a liquidity event. So we trimmed it, basically took our 35% gain and ran. But it was a very safe bet based on this theory of insider trades. And when we see it, we have that dominant, it just gives us an advantage. And that's something we're really specializing and focusing on. We're trying to get AI to help do that a little bit more, and I think it's working at this point. All right, total cross asset market read. Now this brings in dollar, bonds, NASDAQ, SPY, semis, Bitcoin, IBIT, sector rotation, insider distribution into one all collective view on what we see. And obviously feel free to read through that. So bottom line to me is the market remains constructive. Primary trend is still higher. If you look at my survival score that I post, we have some market risk there, predominantly in bonds and relative to the Japanese yen. And whether or not they panic and raise rates, that is the only swan that's out there. The only thing that I can suggest is I think that once we level out here after FOMC, once we get the tone from FOMC with the new Fed chair, right, we'll know whether or not the market likes it or dislikes it really quick. From that tone, then we want to start looking for oversold names, and I'm going to build out about 25% in new positions going into July, simply because July typically is a decent month. June is a pullback month, so we're going to target oversold candidates, clean divergence, and clean bottoming formations. Well, that's what I have for today, folks. Great trading. Until next time.